Hey everybody, it's Michael Martin. Thanks for being here. So check it out. A lot of great comments and feedback emails on the last video that we talked about. How to stay in trades for those, multi-R style returns that really skew your average winner and really grow your account. You know, it was the best of times, it was the worst of times when I was starting out. Obviously my back was to the wall. I had the equivalent of about 13K in today's dollars. And I was inside of a firm that was giving me research every day. So when you don't have a plan, anything looks like a good idea, right? That's the problem. When you don't have your trading strategy down, when you don't know who you are as a risk manager, the problem is that everything looks good. So I had to learn to be very judicious because even then, without the internet, without mobile technology, it was like trying to drink water from a fire hose. Very problematic. But the confluence of that and also the high commissions really kind of backed me into a corner where I really had to be very judicious with my trading, because you have to remember, every time I would take a loser, it was also exacerbated by the fact that the commissions were very high. So I had to be, like I said, super selective in the trades that I put on, knowing that there are different market environments. I didn't know that now, but I know it. I know it then, but I know it now. In that winners can rotate, but other times it's more of a dance with the girl who brought you kind of environment, which is kind of where I think we are right now. Several months ago, we were talking about the dollar falling through and the dollar index selling off, and then that was going to take off bonds, and then the 5-year, the 10-year, the 30-year were all going to weaken. And now, there's been a lot of talk about the next Fed meeting and are they going to cut rates? Well, if they cut rates, that's obviously bullish for bonds. It's also going to be good for stocks. So, for a lot of you who are trading the QQQ, the SPY, the Russell 2K, whether you're using futures or not, again, you can just hold your positions for as long as you possibly can. And that's what people mean when they say you only need one or two really good winners per year to kind of make your whole year. I think the advent of so much technology, and you're getting, you're into discords and telegrams and all this data coming at you, it kind of gives you this false sense that you also constantly have to take action. So today I want to talk about and just remind you, and there's not a lot of sizzle in these types of episodes. As you know, I don't have a Ferrari. I'm not talking to you from my Lambo. Um, but sometimes the best trades, and this was echoed in the first Market Wizards book, was how many times did you hear someone say, the best thing I did in this particular situation was to sit on my hands? And a lot of those guys are executing, like I do over the phone. They're like, I didn't pick up the phone, call my trader to get out of the position. Tying that into the last episode, you can trail your protective stop, right? Because once you make money, I don't look at that as a stop loss. I think words have power. So I'm not anal about anything, but I like to use that expression because I think words matter. Words have a lot of power. And so I'm thinking like protective stop. There's a few ways that you can do it. A popular way is to measure volatility with a 20-day ATR, for example, and, trail every time the instrument that you're in moves up an ATR above your purchase price, you adjust your protective stop by the ATR. So the first one obviously will get you to break even. Then you're up 2 ATRs. Then you'll put your protective stop in at 1 ATR, meaning 1 ATR of gains. It also kind of implies that you're never going to top tick the market. Now, some of that's going to bother some of you because you feel like maybe you have a feel. In my experience, when you're starting out, don't take it the wrong way, but you don't have a feel. Most people don't. It takes a while to develop a feel. It can be done. It's hard to do. It takes a while. If you have it, absolutely use it and exploit it. But what I would like to, if you're thinking about the last episode, though, don't get in the habit of just saying, well, I've made all this money and this is as good as it's going to get. I don't believe a beginning trader has that kind of skill either. You don't know how good it's going to get. And as we just discussed, in 2 months, the interest rate conversation has changed dramatically, which changes and buoys the situation obviously for stocks. And in my estimation, your goal should be to stick with your winners for as long as you possibly can. It doesn't mean you have to become an investor, but there are ways to sit on your winners in such a way that they can produce for you 5, 8, 9, 10R rates of return. Now, the key part of that is to back your way into, like, what is your position size? Is your R a 0.5%? Is it 1%? Is it 0.25%? Right? Because if it's 0.25%, or if it's on the smaller side, then you really need a 4 ATR move, right? Because that's what you do. The ATR kind of becomes your R, right? Expressed in points, to make 1% to your account. This is what I was thinking about when I first started trading my own account. It wasn't to make money on a trade. And I know that sounds like, well, what are you talking about? Of course you want to make money. My goal was to grow my account. And that was just dumbass luck, right? That was my mindset. My mindset was like, man, I had 5K. It's about 13,000 in today's dollars. You can't do a whole lot. So, you can't have 10 names, right? So 10 names is like an investor account, right? I saw one comment on the YouTube channel, and it's not meant to be a dig. I love everybody. This is the way I kind of give back to the community. But you can't make a lot of money if you're going to diversify so much. You dilute your power by having 10 or 15 names in your portfolio. That's an investment account. Again, I'll go back to Bill O'Neill in How to Make Money in Stocks. On chapter, I think it was chapter 12 on money management. And he said, accounts with 20 to 200K should be thinking 4 or 5 names. Now, I don't think you have to put them on all at once. But again, my thinking was certainly aligned with his, in that the goal is to grow your account. And you do that by, prostituting every possible opportunity you can with the names that you're already in. The majority of traders that I know are adding to their winners. Their first taste of risk is really the first course of a 7-course meal. It's just to get a feel for that particular market and to put a tester position on, knowing that if they add risk and then adjust their protective stop to a point where they would get knocked out flat, that's kind of the business that we're in. They were more not looking to just get on base by like an intentional walk, a hit by pitch, or singles. There are people who seem to like that accuracy kind of game. I want to hit singles. I want to get on base. But I couldn't afford to do that. The commissions were too high, and I didn't know enough about, I didn't have any market feel. So all I could do was to say, like, how can I get involved in some of these stocks that are at like 52-week highs or multi-year highs and could go on for protracted moves so that I could really grow my account. If you think about it, you buy, if I buy, 100 shares of a $40 stock and it goes up 25%, my account is up 1,000 or 20%. And that's how I had to think. So I think, as far as goal setting is concerned, it might help you to kind of get off of the I need to make money on this trade per se, and think about how can I manage my risk so that I can actually grow my account, and think of it from a portfolio or more of a macro standpoint, if you will. And I don't mean macro trading. I just mean think about it from the bigger picture. Because if you focus too much on the short term, you could be micromanaging things. And I think that's an illness that's people are overbearing. I get a lot of emails behind the scenes. I answer them all, with a kind of loving, temperament, because, the goal is to help people. But I have a sense that people are, they're in a trade, it starts to win. And it's like that new relationship. There's, you need the constant feedback, texting and instant messaging, and, how come you didn't, send a text message, and how come you didn't get back to me in the first 30 seconds? Like, that kind of stuff makes you look needy. And you don't want to be a needy trader. You always want to be managing risk. Now, if you are a little uptight about things and this is new for you and you need to try it on for size, let's say you buy a stock at 20 and the ATR is a dollar. Every 50 cents you can adjust. So if it goes to 20.50, you can move your stop from 19 to 19.50. So you still have that, $1 risk. Part of it is the unrealized gains. Part of it would be out of your account. So when it gets up to 21, you can move it to, break even. But again, it all depends what percent you're using the ATR for. Are you using that to position size for a quarter point, 1/4 of 1% risk to your portfolio? Because it's hard to make a lot of money with small position sizes. You need, I have a calculator for this, and we go over this a lot in the coaching. Is all right. Now you know the expected value. That's a big first step. But what's your goal for your account, right? Don't lose sight of that. Like, the goal is to grow your account, to grow your wealth, to have financial abundance. It's not to sit back and say, I can do these swing trades left, right, and center, right? That the next step, then the next iteration for you is to see, okay, well, what impact is this having on my money? Because you don't want to be running, as Bono sang in the song from Joshua Tree, you're running to stand still, right? There's a point where you naturally have to grow your account. You naturally have to, scale up and trade it bigger. Like I said, most pros that I know are either starting with their optimal size, or they're very quickly getting involved into their optimal size, and they continue to buy at higher prices. So they add to their winners, adjusting their protective stops along the way, knowing that if the thing doesn't about face, you might get knocked out flat, right? That's just the way that it goes. So, let me address the next thing. Some of you are going to be sitting there saying, yeah, Mike, but half the time the thing pulls back. That's a bullshit response, to be honest with you. If you don't have the data, right? That's armchair quarterbacking. You got to study the numbers, actually, because that's in fact not the case. Sometimes if you're looking at 1-minute bars, right? But who wants to be sitting there doing that? That to me isn't trading. That's being overbearing and not trusting. And I don't want to be that kind of person. So, it's not that big of a deal for me if I buy a breakout and it rallies up a small bit and then comes back to my entry price. It just gives me another opportunity to buy more, right? So I would, know what the numbers are, right? Before you make generalizations, because those generalizations are actually holding you back, right? Until you actually, it's like, I call it Johnny Cochran logic. But the key to this episode is that sometimes you can just stick with your winners. You don't have to worry about rotating. Sometimes there aren't any new trades to add. All you're doing is adjusting your protective stops for the trades that you have on. And then you might consider, like, well, if this trade is working, why don't I add to this risk, right? Because, if I have, 12, well, not 12, because you don't want to do that. If I have, say, 6 positions and each one is a 0.5% risk, my portfolio heat is 3%. Well, why can't you just do that with the 1 or 2 names that are already working? You see what I'm saying? So for your style what the optimal portfolio heat is, what the expected value is. Then the next thing is to know how many trades that you have to put on. One way that you can decrease the number of trades, which is work, is leave well enough alone, right? So go back and watch. There's a couple of episodes that I've done a while back. One is you thought you saw a pattern, but there wasn't one there. And then rewatch the one winners rotate, because those will help give you insight. Because again, I'm coming from the mindset that you want to make money in trading and not necessarily have to be active every day. That would be incidental. If you were active every day, it would just be because that market environment was there. I don't necessarily think that you have to be active and putting on new risk every day. You can just stick with the one that you have, and that's adjusting your protective stops, always managing risk. I'm not saying throw caution to the wind, but that is, for all intents and purposes, the way I know most traders, men and women, have grown their accounts and also open themselves up to have those 5R to 10R kind of winners, is staying with their existing winners for as long as possible. Please like and subscribe. And if you want to get a free copy of the audiobook version of The Inner Voice of Trading, there's a link below, as well as a way to reach out for me if you want to suggest a topic or ask about the coaching. Hope you're enjoying your summer. See you next time.